Hello Futex traders, and welcome to my brief fundamental overview about the euro as a measure of risk. So historically, when global stocks fall, the euro typically falls with them, and when global stocks rise, the euro normally rises. Now in the last year or so, however, it's quite clear that this correlation has changed a little bit, and actually we've seen the opposite, with the euro going up when global stocks are weak and depreciating when the global stocks are strong. And I can show this graphically quite easily by just looking at a chart to show the Euro Stoxx 50 index, which is this orange line here, and the Euro Dollar FX, which is this purple line here. Now, so if we go back to 2010 or even beyond, to be honest, we can actually see quite a tight correlation here, whereby when stocks go down, the euro generally depreciates. When stocks go up, the euro generally appreciates. Now, if we look up until about the middle of 2014, that's pretty much held. But in the last year or so, that correlation hasn't just broken down, it's actually gone the opposite way, which is quite telling really that the euro fundamentally has changed in terms of how it reacts with stock markets moves, and generally stock markets are seen as a measure of risk sentiment. So the euro correlations and with the stocks and a measure of risk has really changed in the last year or so, as we can see, because in the last year or so the stocks markets have gone up and the euro has gone down, which really does change quite significantly from what we saw the 5 years prior. And if I pull the chart back even further, it will be exactly the same. So just to add some statistics to it, according to BNP Investment Bank, during the last year, the euro has tended to fall by roughly 0.1% against the dollar for every 1% rise in global stock markets. The year before, so 2013 to 14, a similar rise in the stock market, so a 1% rise in global stocks corresponded to nearly a 0.4% rise in the euro. So a rise in the euro as opposed to a fall. So what does that tell us? In the last year or so, basically a rise in the stock market has typically been seen as a sign of investors' risk growing, appetite growing for risk, and the euro has reflected that as well. So the question to be asked, I guess, is what's behind the shift? Well, I'd say the euro's previous relationship with stocks began to reverse in the middle of last year, as indicated by the chart, as investors anticipated the ECB monetary stimulus program and an extended era of ultra-loose monetary policy with low interest rates and interest rates low for a long period of time. The ECB rate cuts and QE program has driven down bond yields in the Eurozone and ultimately reduced borrowing costs, and this has ultimately helped turn the euro into a funding currency and get used for so-called what we call carry trades. Now, for those of you who don't know what carry trades are, it's a practice of selling weak, low interest currencies to buy higher yielding assets. And the mechanism through which this is done is as follows. So to borrow money in Europe at the moment is very cheap due to interest rates being so low. So as an investor, you'd rather borrow your money at low interest rates in lower yielding currencies than high yielding currencies. So for example, if I take Europe and South Africa, for example, Europe has near zero interest rates, South Africa has 6% interest rates. If you were going to borrow, where would you want to borrow? You would want to borrow at the lowest rate. So what investors are typically doing is borrowing at low interest rates and investing and essentially saving their money in higher yielding interest rate environments. So taking their money out of Europe, borrowing in Europe, saving in, say, something like South Africa, a riskier place. So if you're ultimately going to take money out of Europe and move it into South Africa, what are you doing? You need to sell euros to do that and buy the South African rand to do that. So essentially, what's going on here is money is being taken out of Europe, put to work somewhere else, hence the euro is depreciating. So over the last 15 years or so, Japan has very much fulfilled this carry type trade. As we can see from this chart here, again, the Euro Stoxx 50 in orange and the dollar yen FX cross in red. Now we've seen as the Euro Stoxx 50 has been going up, and I've used the Euro Stoxx 50 as just a measure of an equity market. I could have used any market really. I could have used the S&P, the FTSE, but I've chosen to keep with the Euro Stoxx. So as the Euro Stoxx has gone up, the dollar yen has gone up. Now this chart is a little bit different from the other one, just because when you quote dollar yen, an upward move in the dollar yen is actually a weaker yen. So you get a weaker yen generally with stronger stock markets, and a stronger yen as represented by a lower dollar yen by weaker stock markets. So as we can see, if we look back 15 years, we've seen essentially what we've seen in the last year or so in Europe. So the yen being used as a funding currency and used as part of the carry trade. So why is this a measure of risk sentiment as well? And this is what I want to draw upon, is how the euro has changed to reflect changing risk sentiment in the markets. So when the markets are steady, we've said investors are more likely to borrow in Europe, borrow in lower yielding currencies, and invest their money in higher yielding currencies. And that generally happens in a risk-on type environment. Investors are more willing to take risk, so they put their money to work in riskier assets. Whether it's the South African interest rate market, whether it's Brazilian stock markets, they're more willing to take risk. So they take their money out of safer haven, lower yielding assets, put them into higher yielding interest rate environments. So therefore, when markets are going along nicely, when there's a real risk-on feel about the markets, we see the euro depreciate and these other emerging markets do better. Now, when markets are under stress, the opposite happens. Investors want to take their money out of risky assets very quickly and return it to the lower yielding, more safe haven European assets. So, and also Eurozone investors in times of stress who had been seeking these better returns elsewhere will likely bring their cash back home. So in essence, as this chart will show, the euro benefits, i.e. appreciates in a risk-off environment. Risk-off environment, what's that reflecting basically? Well, a risk-off environment is lower equities, and a risk-on environment, higher equities. And as we've seen, correlation's been tight here. As we've had a bit more risk on in the last year and a half, higher equities, we've seen a lower euro. Again, just to reiterate, you get that selling in the euro to buy riskier assets elsewhere. So the euro performs well in a risk-off environment and performs poorly in a risk-on environment. So in June, for example, as doubts over Greece Eurozone membership grew, the euro made gains against other currencies and then sank quickly when Athens reached an agreement with its creditors. And even more recently, the euro rallied sharply at the end of July as a big sell-off in the Chinese stock market spilled over into global markets. Again, the euro trading as a risk-based currency. This carry trades, these funding trades, really becoming quite prevalent. And obviously, for the same reason, the recent shift in the euro's behavior could provide clues about where the currency is headed next. If risks surrounding Greece and China continue to subside, what should happen? Well, based on this, the euro could fall further as investors re-enter the carry trades and the currency could depreciate further, as we've seen in the last year or so. And just as a side point, the likely destination for a lot of the cash is likely to be the US, given the growing confidence that the Federal Reserve is close to raising interest rates, which would boost the appeal of the dollar. And that's just a side point. So in terms of trading, therefore, the euro can be traded as a risk-based instrument. We can buy the euro on a risk-off environment, similar to how you would buy the US bonds in risk-off or sell equities in risk-off. And on risk-on based moves, the opposite. You know, you would sell the euro these days on a risk-on environment in a similar way that you would buy equities or sell US government bonds. Now, often on risk-based moves, the equities and bonds will move first. So knowing the correlations that exist and have been existing in the last year or so, the markets may give you some information for free and give you that little bit of extra time to profit out of markets such as the euro that haven't historically been traded in this manner. So really, I want to reiterate the point, we can trade the euro as a risk-based instrument these days. And often it will be a lagging indicator as well. So, you know, if there is the threat of further Greek default, Chinese stock markets, potential bomb run in, you know, in Russia, the Ukraine, any kind of terrorist threat, we know what to do. Risk on or risk off. Risk off, generally buy euro. Risk on, sell euro. It's been holding quite strongly. Now, even if the euro is not something you trade very actively, it can be used as a barometer or indicator of risk sentiment in the markets, and perhaps just aid your understanding if it's not really something you trade. It really is important, however, that we don't have tunnel vision on this. I mean, just because the euro is strong, it doesn't necessarily mean that risk sentiment is poor. By the same token, just because the euro is weak, it doesn't mean that risk sentiment is strong. It needs to be used in your analysis in conjunction with other markets and what other markets are doing to get clarification of this. So, for example, an up move in the euro could come about because of a hawkish ECB and nothing to do with risk environment at all. Therefore, just because some of the correlations have changed, it doesn't actually mean the fundamentals of what drive the currency higher and low have disappeared. It just means there are more factors to consider than may have previously been the case in the past. Okay, I'll wrap up there, but I really do hope you do take this on board, because the euro is really something we should be watching as an indicator of risk sentiment. And I really hope you found this primer very useful, and that hopefully it will contribute positively both to your trading success as well as enhancing your fundamental knowledge and understanding of the euro and some of its changing dynamics. Thanks very much. Hope you can benefit from this. Take care. Goodbye.